Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mate.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am getting used to that opener. I think you gave it a slight tweak, didn't you?
I did change it.
It's good.
Yeah, I actually did a full rewrite.
Did you?
Yeah.
Wow,
After some feedback has come in from listeners, you know who I'm talking about, and didn't feel like Warren would actually get anything out of our episode. So, look, I beg to differ, but I have changed it. But anyway, I'm glad you like it.
You mean Warren contacted you and said he's actually not getting that much out of it?
He actually contacted me and said he's getting a lot of value.
He just listens for the entertainment.
That's fine. That's fine. We're all about educating, entertaining, and engaging.
Well, there was a poll in our Facebook group. Shout out to the Facebook group if you're not already in it. Where there was people were voting on whether you should go back to the old intro. Yeah.
Oh.
Are you clearly not paying attention?
Oh, no. What was the answer?
The majority of people supported your change. But nice. It was more just like, it's Bryce. Let him do whatever he wants to do.
That's it. I'm fast and loose. All right. So firstly, a very quick shout out to all of those that have supported us through our support page, equitymates.com/support, be it a one-time donation or ongoing. Just a massive thank you for those that have done so. Too many names to call out, but you know who you are. A big thanks. So we'll leave it there. Head to the page if you would like to support us in any way. Ren, introducing a new segment.
Yeah.
This segment,
in the spirit of just letting Bryce do his thing, you've got a segment for us.
I do have a segment. I guess the overall theme for this actual episode, though, is how to know when to sell. That is going to be the value that we're going to try and unpack. It has come through from our community a lot of times, so that's the main crux of this episode. But kicking it off with a what the...
What the?
The segment is something that has grabbed our attention this week. And this is something that we want the community to also hit us up with a what the. If there has been something that has surprised you in markets or the economy or caught your attention, head to equitymates.com/contact and leave us with a what the, and we will call it out.
Yeah.
This one
record it.
Record it
Yeah.
and we'll play it. This one... it was just at the bottom of an email from one of our listeners, Nick Wine, and he was talking about other things, but just finished with a PS, raises up 78% this year. And I think that is a what the?
What the?
Yeah. Raise up 78%. That caught my attention out of nowhere because it had been lagging around the sort of dollar mark for a number of months, and it's obviously kicked off very strongly this year.
Now,
off the back of the retail.
I don't know if I'm allowed to ask follow-up questions in
there
this
is no follow-up questions
segment,
in the what the segment.
Do you know why?
No. It's just a what the.
Oh, so that's a good thing about the what the segment. You don't have to have done your research.
Yeah, just caught my attention. Yeah, it's just a what the. And hopefully by the time we put this to air, there might be a bit of a what the segment opener that we can throw to it. But if there isn't, we'll have a chat to our producer.
Yeah. I mean, this whole part of the conversation might be meaningless because people have heard the sound drop multiple times.
True. So we can cut that out. But anyway,
leave it in.
If you want to leave us with a what the, head to our website, equitymates.com/contact, leave us a message or hit us up on email and we can call out your what the.
I like how for people watching us on YouTube, you did the typing action.
Yeah, true. But anyway, let's move to the actual valuable part of this episode, Ren.
I think that was valuable.
Oh, thank you.
Yeah.
Thank you. That is knowing when to sell. And we've obviously spoken a lot about buying stocks over the last number of years and haven't really dug into, the key factors that you should consider about, knowing when to sell. And I'm sure there are a lot of people who are seeing their stocks go up and wondering, should I be skimming profits? Should I be selling the whole thing, putting it into something else? And it's not something that we often tease out of our experts as well when we chat to them is the sell side. They're always obviously talking about the buy side. So in this episode, we're going to unpack what we think are some of the key considerations for selling. And then towards the end, we have called in a few of our experts to just get their sort of 1 or 2 minutes on why they themselves sell.
Yeah. So selling.
Yes.
Where do we start?
Ding.
It's a big topic. I mean, don't you only ever sell when you're 65 and you retire and you cash out all your super and take that caravan trip around Australia?
Yeah, that's it. Hit 65, hit the sell button, and
and
go traveling. Yeah. I mean, it's a tricky one, and we've got some reasons here. But firstly, I think the important thing is to consider who you are as an investor.
Yeah, I think that's the right place to start, because your investing style and your investing philosophy will dictate the answer to this question. So to start with a few examples of investors that we're not, if you're a momentum trader, you're looking at things like trading volume, how much people are buying, like what's the prices doing sort of day to day. Your reasons for selling will be when momentum slows down or when the price turns. If you're a technical trader, so you're looking at charts and you're looking at patterns in charts and drawing lines and all of that stuff, you'll be looking at charts for sell signals. You'll be looking at certain patterns that indicate that the stock price will fall, and that's why you're selling. If you're a GameStop short seller, then you would sell when you realize that you've lost billions of dollars and you need to get bailed out. Like your investing style will dictate why you sell. So let's frame this conversation in the type of investors that we are, the type of investor that almost all the experts we speak to are, and that we think makes the most sense. And from what we can tell, most of the Equity Mates community are. I'd be very surprised if 95% of our community were looking at charts and we're technical traders. Yes. We have really missed the mark on our content there.
We don't know our audience.
So let's answer the question: what kind of investor are you with long-term investors looking to buy great companies that can generate more profit, or take that profit, reinvest it in their business, and grow it over time?
Yeah.
And in this episode, we will touch on selling ETFs or managed funds as well, but we'll get to that. Yeah.
So we've got 5 main reasons here that we're going to go through with the context of what Ren just said. As you know, we're not going to be.
Hold on, 4 main reasons.
4. 1, 2, 3, 4, 5. I'm saying 5.
You slipped a 5th in there, but that's if you read down the page, you would see that it's.
Okay. All right. Well, sure. 4 main reasons with a number of others. So
four
main
reasons. Then there's a myriad of other reasons.
So the first one, Ren, is all about goals. Obviously, if you have reached your investing goal, then it might be a time for you to consider selling. And, if you think about people will use the stock market perhaps to save for a deposit on a house. They might use it to, as you said, retire, those sorts of things. If you reach your investing goal, then it kind of makes sense that you should consider selling and using the money for whatever that goal was.
Yeah, and let's get more specific here. Well, first of all, we don't like the idea of saving for a house in the share market, because the share market's incredibly volatile. But speak to a financial advisor or whoever's advising you on buying a house about that. But that's off topic, but just given you said it had to be responded to.
Yeah.
But yeah, like if you reach your retirement number, if your investing goals have changed, you would probably sell a lot of your growth assets and move them to, income paying defensive assets that will sustain your lifestyle in your retirement and stuff like that. Or if you quit your job and your investment goals have changed, or your needs have changed, that's going to be the first time to sell. So it's not related to what's going on in the companies, it's what's going on in your personal life.
Reason number 2, and this is probably the biggest for us, and it has been indicated by a lot of the experts that we'll speak to later as well, but that is to sell when your thesis has changed. And for those that have just joined the show, a thesis is really your reasoning for buying the stock in the first place. If that changes and you no longer can say the reason you bought it is the reason that you're still holding it, then it's time to sell.
Yeah. There's a concept in investing known as thesis drift, and basically what happens is You find a stock, you do some research, you formulate a reason to buy it, and you fall in love with the stock. And, over the time, you convince yourself that it's a good stock, and eventually maybe the reason you purchased it in the first place no longer applies, but you love the stock and you've done so much research on it and you've got such an affinity for it that you keep holding it and you give yourself new reasons to hold it. That's something you should avoid, because if you formulate a reason to buy it, that no longer applies. It probably means you should sell it.
Yeah.
To put it bluntly, you were wrong.
Yes.
Or the company failed to do what it said it was going to do.
Or you weren't wrong in an initial investment point of view, but things have happened, environment has changed where that company is no longer, perhaps the leader in the industry, or they've changed management and you think the management's not going to be able to lead the company very well. So you may have been right, but for various reasons, your thesis may be changed or may be wrong.
That's a fair point. You were you were right for, if you bought if you were right for 20 years and then something changed.
Yeah,
your thesis
time
was
to
broken.
go.
Yeah.
Just a quick one on that is, how do you know if your thesis has changed? This is where you do need to sort of be across your companies. The best time to understand or review your thesis is reporting time. We're going through reporting time here in Australia at the moment and overseas, but your companies will be releasing reports on how they're performing, what's their strategy over the next sort of 5 years. Great time to review your thesis and understand what's going on.
Andrew Page, who we will actually speak to later in the show, we'll call him and ask him this question, knowing when to sell. But he once, either on our podcast or on our TV show, at some point when we spoke to him, he spoke about how he checks his thesis every time there's new information. So every time the company releases like a half-year report, or every time there's a major change that the company's talking about their results or they're giving news to the market, he would just read that and then check that against his original thesis to make sure that whatever's happening is in line with his thesis and, it's not broken. There's a famous US investor, David Einhorn, who ran Greenlight Capital, like billionaire American hedge fund manager. He had a hard rule, no broken thesis rule, where as soon as the original thesis, the reason that you pitched at the investment committee that you wanted to buy that stock, as soon as that was broken, had to sell. It was like a hard rule across his floor.
Which makes sense.
Makes sense. Because to me, you might formulate a new thesis that may be correct and may be a reason to hold it. And if you have a new thesis, that's fair, and maybe that's a reason why you hold it. But the important thing is you're not just letting your thesis drift, and you're being pretty disciplined in terms of, do I actually have a reason to hold this, or do I just now sort of like the company?
Yeah.
Yeah.
All right, so reason number 3 to consider when to sell is when the price of your stock is fully realized. Now, what does that mean? Well, it means if you've put in the work and you say, I'm buying this company at $5, but I believe that if everything goes according to my calculations, it's worth $50. If it hits that price, then it might be a reason for you to sell, because everything in your formulas and your modeling and your research, has led to this price point. So that is a consideration. I guess the question is, what about thinking if it's going to continue to run beyond 50?
Yeah.
And then also a company that you're holding for 10, 20 years, how do you recalculate? And I think that's sort of the key, is to reevaluate when it does hit that mark.
The way to think about, when your price is fully realized is probably don't think about a lot of the companies that we talk about here. Because, an Apple or a, Amazon or a, even like a Woolies or a Coles, like, in theory, they make a whole bunch of profit every year and then they find ways to reinvest that capital. And if the company is managed well, there should never be a fully realized price. There will be times where they're expensive based on their current profit, but over the long period of time, if they can keep growing, it's difficult to know when they're fully realized. Conceptually, it's easier to understand this if you think about like a mine, and a mine has 100 tons of coal over 10 years. It'll take 10 years to extract that coal. The coal is worth, X dollars a ton. you do a discounted cash flow and you say, well, this is what it's worth today. And that's sort of fixed. And then it's all easier to say, well, what's the value of it? What's the price in the market? Is it fully realized? Is it cheap? Is it expensive?
Yeah.
But yeah, I really struggle conceptually with this one because philosophically, a lot of the companies that I buy, I don't think about their growth stopping and their price being fully realized.
Yeah, I agree. This is probably one that I don't really think about when it comes to selling, because you're right. All the companies that I'm investing in, I consider to just hopefully continue growing and growing and growing. Yeah.
There is another concept here about, like, you know how we talk about the time value of money, and so like $1 today is worth more than $1 in 5 years. Let's take a company like Afterpay, which is trading at $100 a share now.
158, I think.
Jeez.
Yeah.
I think most people can agree that based on Afterpay's current business, $158 a share is expensive. And so you might say it might take 10 years for Afterpay's, intrinsic value to be worth $158 a share. And so you might say, well, look, I might sell it now because it's valued at what it should be valued at in 10 years. So I don't expect the next 10 years to have a lot of growth because the market's already put that price on it, if that makes sense.
Yeah.
So you could do that, but then, Afterpay is an example. Like, if it just keeps running the way it has, you'd be kicking yourself. It'll be like $1,000 by March.
Yeah, yeah.
No, obviously not advice. Obviously said facetiously. You need to be careful about what you say about Afterpay.
And then the last one, Ren, is if there's a better opportunity out there.
Yeah.
Yeah, so that's pretty straightforward. If and this is obviously if you don't have cash on the side, or you find that if you might be getting better returns if you sell a stock and put it into an opportunity that you obviously think is going to give a better return, then it's an opportunity to consider selling.
Yeah,
pretty straightforward.
So to recap, the 4 major reasons, and then we'll get into Bryce's mystery 5th reason in a sec. But the 4 major reasons is your investment goals have changed, and that's really about you, your lifestyle, your life circumstances. Secondly, when your thesis is broken, so the reason you bought the stock no longer applies. 3, when the price is fully realized, so there's no value left in holding it. And then 4thly, where there's an opportunity to do something better, to buy a better stock.
And before we jump into my mystery 5th, we're going to take a quick break to hear from our sponsors. So, Ren, there are a number of other reasons to consider. Obviously, those 4 are the 4 that we think are applicable to us and our journey and our context.
Yeah, I think the 4 are the most important. These ones obviously have a role, and we'll get to it, but less high in my thinking as a 28-year-old thinking about investing for the next 40 years.
Absolutely.
Hopefully longer.
The one that I was trying to sneak in there for the 5th is all to do with portfolio management and rebalancing and diversification.
Yeah.
So a lot of fund managers set their portfolios up to have specific allocations to either certain stocks or certain asset classes.
Yeah.
And if your portfolio or a certain position in that portfolio grows to exceed that allocation, then they will trim it and sell. To give a very practical example, I might say that I don't want Afterpay to be more than 10% of my entire portfolio value. If it starts hitting 11, 12, 13%, then I will sell enough units that it'll bring it back down to 10%.
Yeah.
Kathy Wood, which she has a similar sort of approach, which...
most fund managers do.
Yeah, exactly. So something that I don't really do, to be honest. I don't have a rule around rebalancing. Yeah. But it is something that the professionals do.
Yeah, and if you read content that's put out by financial advisors, they'll often have something similar, like a 5% rule where no one stock or no one asset is more than 5% of your worth, and things like that. And it's all about diversification and reducing your risk. It does make sense. Here's my philosophical problem with it. Let your winners run.
Yeah.
As a non-professional investor who doesn't have obligations to, my shareholders around risk management and stuff like that, Because that's why hedge funds do it. You know, they've got to manage their risk and they've got mandates and stuff like that. For me, I have no such mandate. And you're a better example. I'm sure at one point Afterpay was a meaningful percentage of your portfolio.
Yeah.
To stick to an arbitrary percentage and say, I'm worried about the volatility in my portfolio, so I'm going to only allow Afterpay to be 10%. You would have cut your nose off to spite your face. You would have lost actual real money in the vain search for some arbitrary portfolio protection.
Yeah.
Like if it's a good company and it's going to continue to be a good company and you think it's going to continue to grow, it doesn't make sense to sell.
Yeah, no, agreed.
Yeah. Anyway, that's my issue with it. It makes sense. Professionals do it. If people want to do it to protect against volatility and stuff like that, it obviously has a place. Speaking personally, I'm going to let my winners run.
Yeah, for sure. Cut your losses, if anything.
At one stage, A2 Milk would have been more than 50% of my portfolio. At one stage, I had A2 Milk, Slater and Gordon, which was cratering fast, and like maybe one or two other stocks. If I had said I need every stock, let's say I had 4 stocks at that time. If I said I need every stock to be 25% of my portfolio, I would have been selling a lot of A2 shares on the way up to buy something else on the way, that wasn't performing as well. Yeah.
And the final sort of reason that, again, this is probably more to do with where you are in your investing journey, and also some professionals do it as well, but that's tax loss harvesting. So selling for tax purposes. Again, this is something that you should talk to financial advisors about, though, and it's not something that you or I do.
No, the only thing that you might think about at this stage in your life is if you're going to sell anyway. So if you're going to sell anyway, you might want to time your sell, but it doesn't really matter, because if you lose money on a share and you report that to the ATO in Australia, you can claim that, you can offset that against future gains on shares in future years. But financial advisors will then start doing all this stuff about, well, you've lost money on a stock. If you still want to own it, why don't you sell it and then rebuy it and claim the tax loss, because that'll be more beneficial than the additional brokerage you have to pay. Like that's where financial advisors can really help. They can look at exactly what's going on with your personal circumstances and make those recommendations. We're not going to do that.
No.
But yeah, you may sometimes sell for tax reasons around harvesting those losses.
Yeah. So yeah, we've touched on capital gains there, and there are tax advantages. So please check with your accountant, though, rather than taking it from us. But
don't take financial advice from a podcast.
There are a couple of other key considerations around thinking about selling, and of course, Ren, you and I guess firstly, the longer you leave stocks, broadly speaking, in the market and let compounding do its thing, that's where the magic can really happen. So from our point of view, selling is not really necessarily on the cards in a big way.
Oh, no, don't get me wrong. I've sold stocks that I was wrong about.
Yeah, but I'm saying just like everything that we've sort of spoken about, fully realizing price, thesis broken, investing goals. Your goal really is in 40 years' time to be able to have a meaningful portfolio that compounding's done its work. So when we come at it like that, if you continue to sell and churn through, you're not going to be able to let compounding do its thing.
Exactly. Yeah. Now, I want to quickly touch on ETFs and managed funds, just for people that primarily invest in that space.
Yeah.
So I think the headline is these products, ETFs and managed funds, are designed to be long-term vehicles, long-term products, long-term investments. And so really your decision to buy or sell is primarily based around your lifestyle. So, if you're holding a ASX 200 index, you're not worried about the price being fully realized, because the thesis is that the market will continue to go higher as humans, become more efficient and, apply their ingenuity to design new stuff and all of that good stuff. So, you're not worried about the price of an index tracking ETF per se. Your thesis, again, like you're not worrying about a broken thesis if you're just investing in like the ASX 200 index, because the thesis doesn't break. The thesis is over history. It's returned a good return and it will continue to do so. So you really are thinking about your personal circumstances and is this investment right for you? You may also sell because there's a better opportunity out there. You might want to sell some ASX 200 ETFs to buy something. But generally, to your point around compounding, you should try and avoid that. Just set and forget that core ETF portfolio. With managed funds, the only other thing I would add is if the manager sucks.
Well, hopefully you didn't go into it if the manager sucks.
Yeah. But sometimes the manager can sound good.
Yeah.
And you can
not
be
what's on the tin.
And it's, it sucks in relation to their fees. Like the best investor in Australia, if Hamish Douglas was charging us a 10% management fee, you'd have to say he sucks in relation to his fees. That's really all I have to say.
Nice.
But Hamish Douglas, you don't suck in relation to your fees.
So we're going to take a very short break to hear from our sponsors, and then we're going to hear from a few experts from the Equity Mates community to hear their thoughts on why they sell. So, Ren, we're going to call 3 experts, Rory, Andrew, and Jess, to hear their thoughts on why they sell.
I hope they don't just disagree with what we've said.
I know. Good news if everything we said is similar to theirs. But we have Jess Amir, who is market analyst at Bell Direct. And Jess, the question is, how do you know when to sell?
Good question. Well, I think as an investor, you need to have a set of core values. And the first one, going into buying a stock, is pretty important. You've got to have big balls. You've got to have conviction to first buy a stock, right? So I guess when the chips are down, when the tough get going, you need to remember your core values and why you first bought. And I guess if things haven't changed and the company's earnings are still growing and they're still kicking goals and hitting milestones, then you should probably hold, right? Hold. But so bottom line is you've got to have a core. Think about your core values, and if the underlying rationale for first buying a stock, or if your convictions change, that's when you'd sell. I wouldn't sell if a business is still kicking goals. So you've got to remember the key milestones, and if a business is continuing to grow its earnings.
We've got Andrew Page, the founder of strawman.com. Andrew, how do you know when to sell?
It's a really thorny question, but for my mind, there's only really 3 reasons to sell. First is your thesis is broken. The underlying investment case, the reason that you bought the shares, is shown to be no longer valid, or your interpretation of the facts have changed. And when that happens, sell and sell decisively. There's no point hanging on after that point. The second is if shares are too expensive, and this is a really, really hard one. The market can do some really crazy things. Sometimes it gives you a bargain when it falls away, but sometimes it can make really, really great companies too expensive. And that means that you can actually get very poor returns, even if the underlying business is performing well and expected to continue to perform well. So you have to do a bit of valuation work there, and you don't want to be too fussy. There's nothing more painful than selling something because you think it's 3% above some arbitrary concept of value that you've come up with. But at a point, it is something that you want to consider. And I think the only other point is portfolio management. Sometimes, if you get particularly lucky, you'll find that you buy a range of shares and one of them performs exceptionally well, which means that you wake up one day and 40% of your portfolio is composed of one stock. Now, that's a great problem to have, but just for risk management reasons, it's something that you might want to look just to adjust a little bit. Before I go, guys, I know this isn't the exact question, but I'd add a couple quick points here. There are reasons not to sell. And one reason not to sell is because the price goes up. Stocks can actually get cheaper as they rise in price. In other words, the value the stock can become more valuable even though the price has gone up because the business's prospects have just improved at a greater rate. And it's the same with the price falling. In fact, you may even find that the shares are more attractive as the price goes down. Price alone is not going to tell you anything without any sensible reference to valuation. And the third reason not to sell is because you predict a market crash. We all feel as though we can do this at times. We're almost always all going to be wrong. So don't even bother trying to do that.
I like that. Reasons when not to sell. And as Bryce is someone who predicted, 3 years running that we would have a bear market and was wrong 3 years running, I think he's learned that lesson all too well.
I know that pain too, Bryce. I know that pain very well.
So we are joined by Rory Lucas, Chief Investment Officer over at HM1. And Rory, how do you know when to sell?
Yeah, it's a good question, and it's a very important question, just as important as it is to know when to buy a stock. The one-line answer is when you think that the stock is no longer a bargain or no longer cheap, and that sounds pretty obvious. But the way our guys look at it, from a funds management perspective, fund managers have generally got investment mandates. And within those, they have guidelines, and it's very public information. But Cathy Wood, who has been the superstar of our last couple of conferences, her investment mandate requires her to trim positions, in other words, sell some of the holding, whenever that holding becomes up to 10% of the portfolio. So no stock, Tesla included. So whenever Tesla became more than 10% of the ARK Funds portfolio, Cathy trims it. That's the mandate. So that's one way of how to decide when to sell. A simple one-liner that I was always taught as a trader is this: if you wouldn't buy it at today's price, you should probably sell it. And the trading 101, if it's not a buy, then it's a sell. So that's my second perspective on it. And for a lot of your listeners who are a bit younger than me, my 22-year-old son gave me I asked him about it, and his answer I thought was really good. And it's a bit, everyone's heard of FOMO, fear of missing out. But another way to think about when to sell a stock is if you're more worried about losing some of the gains that you've made when you've bought a stock, then you would feel bad about having sold it and seen the stock go up further, then you should sell it. I reckon that's a really good one. So if you've bought a stock at $5 and it's gone to $10, you look at it at $10 and you go, if this goes back to $7 or even back to $5, am I going to feel worse than if I sell it and it goes up to $20? Will my fear of missing out be greater than my fear of giving back some of the profits? So that's how I look at it, and how my son looks at it, which I thought was really quite insightful.
So, Ren, there we have it. Luckily, what we spoke about at the top of the episode has been echoed by these experts, which is good news. So that brings us to the end of the episode. I hope that has been able to answer some of the questions in the Equity Mates community that you may have around when is a good time to sell, a few things to consider. So,
You'll never lose the uncertainty of, I've made 400% on my investment. Should I take my profits or should I let it run? Like, that is, by its nature, investing.
Yeah.
And it will depend on the stock.
Absolutely.
Yeah.
So we will leave it there. A reminder that Equity Mates doesn't stop when you have finished this podcast. You can contact us at contact@equitymates.com. You can follow us on all the social channels or head to our website, equitymates.com/contact. Equally, we also have the Get Started Investing podcast, which is for all those beginner Buffetts, and our Comedian vs. Economist podcast, all about the macroeconomics out there. And lucky to add to the list, our Meet, Pay, Love podcast, which is all about the money side of relationships with Zoe and Carmel. So if you are not subscribed to that, head over and check it out now. But as always, Ren.
Geez, that outro is going to get longer and longer.
It's been fun to chat, and we'll chat next week.
Sounds good.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.